Did you know that 90% of new investors lose money in their first year? It's not because they lack capital, it's because they lack a system. Most people treat the stock market like a casino, buying shares based on social media hype or a lucky tip. But wealth isn't built on luck, it's built on data. Welcome to Invest Insight. Today, I am going to share a professional 4-step stock research process used by successful investors to separate the true winners from the value traps. If you want to stop guessing and start building a high-performing portfolio, this guide is for you. Let's dive in. There are over 50,000 listed companies globally. You can't analyze them all. Step 1 is using a stock screener like Finviz or Yahoo Finance. For beginners, filter for companies with a market cap over $2 billion. Focusing on mid-cap and large-cap stocks provides a safety net. These companies have proven business models and are generally less volatile than penny stocks. Step 2 is a rule Warren Buffett lives by. Never invest in a business you cannot understand. Start by visiting the company's website and finding the Investor Relations section. In the United States, look for the 10K report or the annual report in the United Kingdom and Europe. Focus entirely on the business overview. Ask yourself, is their product essential? Do they have an economic moat? This means a competitive advantage that protects them from rivals. If you can't explain how they make money in 2 minutes, move on. Step 3 is where we look at the numbers. You don't need to be an accountant, but you must check 3 vital signs. First, net income growth. Is the profit increasing consistently over 5 years? Second, the debt-to-equity ratio. Avoid companies drowning in debt. A ratio under 1.0 is usually a healthy sign for most industries. Third, free cash flow. As the saying goes, revenue is vanity, profit is sanity, but cash is king. Positive cash flow proves the company is actually generating money to pay dividends or innovate. Step 4 is valuation. Remember, a great company can be a terrible investment if you pay too high a price. A primary tool is the price-to-earnings ratio, also known as the PE ratio. Compare a company's PE to its industry peers and its own historical average. If the PE is sky-high compared to its growth, the stock might be overhyped. Professional tools like Seeking Alpha or Morningstar can give you these benchmarks in seconds. To summarize, filter for size, understand the business, verify the financials, and never overpay. Investing is a marathon, not a sprint. Success comes to those who do their homework while others are chasing trends. If you found this framework helpful, hit the like button and subscribe to Invest Insight. We're building a community of educated investors across the globe. What is one stock on your watch list right now? Let us know in the comments below. Thanks for watching.